Very good evening to all of you. Welcome to today's YouTube live session with me, Srujit Kakar. Today is Sunday, 28th of January 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So today's session is our practical application of demand supply methodology. So in case you people have not yet learned the methodology, now our course is an absolutely free course. It has been a paid course for the last X number of years, but recently we made it absolutely free. The link to the course content is available in the description. So those are YouTube videos where we have covered this in two parts, the basic lessons and the advanced lessons. So if you have not yet learned the methodology, it's freely available to all of you. And I would also like to add that if you're not subscribed to my channel, make sure you subscribe to it so that you don't miss on these live practical sessions. And yes, if you have some friends or family members who are into trading, you can share the link of the courses with them as well. And if you are on some trading groups, you can also share there. I know a lot of people are struggling with trading, and you never know, right, what content might help them. So yes, if you want to share, you can definitely use those links and share it with your family members, and the trading groups. So again, what we do in the weekly practical session is that whatever we have learned in the basic lessons, advanced lessons, now we apply to some practical examples so that we can understand how to plan trades in a very mechanical and rule-based way. Now, at the time of analysis, I do not disclose the name of the symbol that we are analyzing, and the reason behind that is these sessions are not to give you ready-made trading ideas or spoon feed you. These sessions are for you to understand how to apply the complete methodology. But yes, once these trades they get triggered, we also review them, and at the time of review, I definitely share the name of those symbols with you. So we do have one trade which is getting carried forward. I shared that trade on the 30th December 23 session. So on the 30th December 23, we did the analysis for a symbol, and it got triggered on the 18th of Jan. And then when we reviewed it on the 21st of Jan, I gave you the name of the symbol. The name of the symbol was ABFRL. And we talked about that we did get the opportunity to make it as a break-even trade. And we also talked about that going with the rules that I've given you in the rule book. Once it starts moving in our favor, we can trail on to it. So we'll continue from where we left. We'll review it. After reviewing ABFRL, we also have another trade that I shared with you on the 21st of January. So today I'll reveal the name of that symbol as well. We'll also review it. And after doing the review of these two symbols, then we'll start with our analysis part for today. All right, so starting with the ABFRL. So, like I said, I shared it with you on the 30th of December session. So again, all these sessions are available as recordings on my channel. So it's not that, we are analyzing it after this has happened. We have already analyzed it in the past. So if you want to watch the past sessions, you can go to the particular dates which I'm telling you, which is 30th of December session. The first review was on the 21st of Jan. So you can also watch those sessions. So everything is transparent. It is available to you. The content is available forever. So you can always go back and watch if you want to watch those sessions. So yes, we did talk about that at 1:1, we could make the trade as a break-even trade. After that, I talked about that, yes, we do have a supply zone here, and we also have a formation of a demand. So if this supply gets violated, we can revise our stop loss from the break-even point to the distal line of this demand area, which will be approximately 1.5, which will be the worst case scenario, that in case prices they start moving down, we still get about 1.5. And this is what we were looking as our target, which was approximately 6:1. So how did this trade progress moving ahead? So this is what happened. Moving ahead, the very next day, first, you can see this is a red color candle, but if you go to a smaller time frame, you'll be able to see that first prices they started moving up, and when the prices they moved up, this supply zone was violated, which means now you could have revised your stop loss from break even to the distal line of this demand area, which would have given us approximately 1.5, because when the prices came back, you would have been out of the trade as a trailing stop loss, and you would have got 1.5 on this. Now again, like I have been saying in almost every other session, the rules that I've shared with you are conservative rules, because whenever we are learning something new, it definitely makes sense to start a little conservative. But with time, with experience, if you want to make modifications to it, yes, those modifications can be done. And I have students who, when plan trades, they only have two outcomes. It is either the stop loss or the target. They don't even have anything in between. They don't make it as break even trades. They don't trail onto it. And the reason for that is they are very conservative. They are already picking best of the best trades. And when they know they are picking best of the best trades, they are just holding on to their positions for either to hit the stop loss or to give them the target. So again, eventually, based on your experience, based on your personality style, modifications can be done. But while we are doing our reviews, we will be doing our review based on exactly what I've given you in the rule book. And based on that, this would have been approximately 1.5 is to 1. And that is where you would have got your exit. But if you look into the trade, what happened eventually, you can see eventually price again started moving up. We had the supply area here which was violated. Anyhow, it was tested zone, so we don't look at tested zones as our target. Like I said, this zone was our target 1, and you will see that eventually we definitely made into it. So you can see this is where you could have got your target if you're looking for your target. The fact is this also got violated, and you can see prices, they went even further up to the next area of supply, which is right here. So yes, the move definitely gave us it definitely gave us a move which could have easily given you your 6 is to 1. In fact, it gave you more than 6 is to 1. But like I said, while we are doing the reviews, we will be doing the reviews based on exactly what I've given you in the rule book. That is a conservative approach, based on which we'll call it as about 1.5 reward to risk ratio on this trade setup. And again, you can see clearly what we always talk about. Now, the people who would have sold after this huge drop, now they'll be thinking, why only after I sell prices they start moving up, because they don't realize they are making these novice mistakes. So that's your ABFRL, which was getting carried forward, and now we will be closing it because we have got the exit on this as a trailing stop loss, which was about 1.5. Otherwise, yes, it definitely gave us a move which is maybe 6 is to 1, 7 is to 1 as of today. All right, moving on to the next trade which got triggered. So just give me a second. Let me bring this up for you. It is just going to take me a few more seconds. Oops, my bad. So it's going to take me a few more seconds. Just bear with me. All right, so the other trade which got triggered is this one. I'll just bring it back in a second. It's this one, which is Electrics. I did the analysis for this the previous session, which was on the 21st of Jan. This got triggered on 24th, and today is 28th. That is when we are reviewing it. Now, at the time of analysis, this was a type 2, type 3 trade for us. Now, how do we take type 2, type 3 trades? So when we did the analysis, it would be something like this. Or maybe we were somewhere in the past. So when the prices, they started coming close to our zone, you can see our reward to risk ratio is 1 is to 1, 2 is to 1, 3 is to 1, a little more than 3 is to 1, which is good. But the thing is, it was a type 2, type 3 trade for us. Now, how do we take type 2, type 3 trades? For type 2, type 3 trades, we go to the refining time frame. And now we have to wait for a bullish or a very bullish candle to form before we can take a type 2 or a type 3 trade. So here you can see prices came into the zone. And from the very first candle, we got a really nice quick reaction. It definitely went a little past the distal line, but it did not hit our stop loss. But again, this was a type 2, type 3 trade. So we had to wait for a bullish candle. But now the zone has already been tested, which will now disqualify this as a trade setup for us, because if the zone is tested, we would not like to trade a tested zone moving forward. But you can see again prices came back into the zone, and just to help you understand how do we take type 2, type 3 trades, you can see second time again we got a bounce from this area, and then we again came into the zone third time. And this time you can see we had a formation of a bullish, in fact a very bullish candle. So this is what we do when we are trying to do type 2, type 3 trades. If this was the first time prices were coming into the zone, this would have been the signal for us that we have now a very bullish candle. So as a type 2 trader, we could have immediately bought at the current market price, which would have been cheaper than the proximal line. And if you wanted to do it as a type 3 trade, then you would be participating in the trade when the prices were leaving the zone. But again, since the zone has already been tested twice, even though we have this bullish signal now, we cannot take the zone because we only prefer to trade fresh zones on the lower time frame. But yes, if we look as of now, what has been happening, the zone has been tested multiple number of times. It has still been holding. The stop loss has not yet been hit, even though the distal line has been breached. But yes, whatever our stop loss was, it is still intact. But yes, going with the rules, type 2, type 3, we would have not got the opportunity. And that's your Salzer Electrics, which was shared during the previous session, I believe. Yes, 21st would be the previous session. All right, so that takes care uh, of the examples I shared with you in the last few sessions, and some of these trades which got triggered. And now we'll start with our trading idea for analysis for today. So just give me a second. Let me bring that up. And then we'll start with the analysis part. So just bear with me. I'm just setting up my charts so that we can start with this one. All right. Almost done. Perfect. Let me go back here. And you should be able to see my screen now. Perfect. So whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based? The reason for that is if we are not trading based on rules, then our trading decisions will be based on emotions. And if your decisions are based on emotions, you can never be consistent with your approach. And if your approach is not consistent, your results will not be consistent. So that is why it is very, very important that when we are planning trades, we need to be mechanical and rule-based. Now, how we should start with this, I have explained this in a video, and the title of that video is How to Start Trading. Now, during the session, whenever I'm talking about any videos or let's say some files or maybe some playlist, all the links are available in the description. So you don't have to worry, where do I find these videos, or where do I find these files for downloads, or where do I find these playlists if I want to watch. All the links are available in the description for both the languages, English as well as Hindi. So do not worry about it. All you need to do is just go to the description and you'll be able to find all these links. So yes, coming back to, like I said, the video is How to Start Trading. If you're not yet watched that video, do ensure you watch it, because it will help you understand why you need to be mechanical and rule based and what process you should be following, because you will have to go through that process eventually, right? So the sooner you start, the better it is going to be for you. So make sure you understand that process, you follow that process. The sooner you'll start, the easier it will start getting for you to make your decisions based on rules and less lean against your emotions. And that is the only path to go about. So yes, it is easier said than done that we have to create a trade plan, because reason is, unless until you have a good understanding of a methodology, creating a trade plan in itself is a challenge. So what I've done is I have created a trade plan for you, which is a combination of two documents. The first one is your trade plan steps, which we can call as the flowchart or the walkthrough. And the second one is your rule book. And we use the combination of these two documents during our practical sessions to understand how to plan trades very mechanically rule based. Now, this rule book that I've shared with you, like always say, is a conservative approach, because whenever we are learning something new, definitely makes sense to start a little conservative. But as you start having more and more experience, yes, you can make modifications to it to make it better suit with your personality style. So yes, do ensure that you start conservative, but eventually modifications can be done. So what is our step number one when we start planning our trades? So whenever we start planning our trade, our step one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the stop loss, the exit can also be the trailing stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose? And the reason is, when we do our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available. Out of these n number of time frames, which time frame should I be using for my analysis? And to overcome this challenge, we do not start by randomly selecting any time frame. We again follow a very logical approach, and that logical approach is that the longer I want to be in a trade, and that means the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. And what I've done is I have divided these trades into 4 different purposes. We call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that the duration of the trade will last for an hour or maybe few hours, nothing more than that. Similarly, daily income, a trade which can last for a day or few days, weekly income, trade which can last for a week or few weeks, and monthly income, a trade which can last for a month or few months. Now, very important, Uh, by definition, I said daily income is a trade which can last for a day or a few days. But when you're trading markets which are not 24 hours market, like our NSE market is not a 24 hours market, it is only open for 6 hours 15 minutes, and then it closes, and then whenever is the next trading day, we again open. And I'm pretty sure all of you would have experienced whenever the market opens, some stocks they gap up and some stocks they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting in that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that particular trade. So we understand that whenever we are keeping a position overnight, by keeping a position overnight, it has that inherited overnight gap risk which cannot be avoided. And that is why my recommendation to all of you is initially when you're learning a new strategy or a new methodology, you're lacking the experience, you're more prone to making mistakes. So that is why initially your hourlies and dailies will remain strictly as intraday trades. You will not do them as overnight trades. You don't want to take that unnecessary overnight gap risk. Now, in weekly monthlies, we are not expecting to get the exit the same day. So here we have no choice but to keep them as overnight trades. But that does not mean that for weekly monthlies, we cannot have gap against us. It can happen. But since we are leaning against some bigger time frames, the probability definitely reduces. But yes, we can still have gap against us for weekly monthlies. But but the problem here is we have no choice, because anyhow we are not expecting to get the exits the same day, so we'll have to keep them as overnight trades. But with time, with experience, if you want to include daily incomes into overnight trades, that can definitely be done. It's just that initially we want to avoid that unnecessary overnight gap risk, due to which we'll do them as strictly intraday trades initially. So yes, my step one is I need to define my trade purpose, and let's assume I opted I want to plan weekly income trades. Now, once I have selected my purpose of trade, what is going to happen from the rulebook, I'll get to know what time frames I should be using. So if I go to the rulebook page number 28, we start with the topic, which is multiple time frame analysis, because demand supply is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis, lower time frame is the time frame where we identify the areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And the answer comes from this table. Now again, remember, the NSE market is only open for about 6 hours and 15 minutes. That is why I've given you a different table for NSE. But if you're trading markets which are open for longer durations, then you can refer to this table, which is on page number 32. Like for commodities, for forex, for cryptos, right? These markets are open for longer durations. That is where you can use these time frames. And for the NSE specifically, which is only open for about, like I said, 6 hours 15 minutes, you can refer to this table. Now in this example, I want to plan weekly income trades, and as a weekly income trader, from this table we got to know our time frames will be weekly, daily, 60 and 15, out of which weekly will be the higher time frame, which is used for curve analysis. Daily will be the intermediate, used for trend analysis. Lower time frame will be 60 minutes. That is where we get our SETS from. SETS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then our refining time frame will be the 15 minutes chart, which can be used for multiple purposes like type 2 type 3 trades, for fine tuning the zones, or in case we need to apply some additional rules. That is also where this time frame can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using, plus what analysis I'll be doing on each and every time frame. So my challenge number 1 is taken care. Now comes challenge number 2. And that challenge number 2 is, yes, I do know my time frames, but on NSE, we have approximately 2000 plus companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what we need to do now is we need to have a process in place using which I can get a smaller list out of these 2000 companies, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 companies every day, not an easy task. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they work is we input certain conditions into them, that these are the conditions I'm looking for. And then that computer program identifies that out of these 2000 companies, which companies are matching with these conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. So a few examples of these scanner screeners. Example one, if you go to my website under the free tab, you will see I have created some scanners for you for all different trade purposes. And those scanners are based on some moving averages. Second example, on my YouTube channel, if you'll search for scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners, but you're not only restricted only to these 3-4. I'll show you a few examples before we move ahead. So like I was talking about, that once you go to our website, under the free tab, here you can see you have a stock screener. You have all the 4 trade purposes available to you: HIT, DIT, WIT, MIT. In this case, because I opted, I want to plan WIT trades, I can click on it. I can run the long scan and the short scan. So here you can see the long scan is shortlisting 4 symbols for me, and the short scan is shortlisting only 1. Now, very, very important. Just because I'm getting these 4 symbols from a long scan does not mean I can blindly buy these 4. Similarly, just because I'm getting this 1 stock from the short scan does not mean I can blindly sell this one. What you need to remember is that the job of the scanner is not to tell you what you need to buy or sell. The job of the scanner is, I can't analyze 2000 plus companies every day. Help me get a small list. And it gave me a list of 4 plus 1, which is 5 stocks to look into. So now I have to manually analyze these 5 stocks. Out of these 5, if anything matches with my trade plan, it can be my trading opportunity. If nothing matches with my trade plan, I don't have anything available for, let's say, today's analysis. So that is what you need to do. Do not assume that you can blindly buy, sell these stocks which the scanner is shortlisting for us, irrespective whatever scanner you might be using. Now, again, coming back to, at times what can happen is the list which you're getting might be a very small list, or maybe the scanner does not list anything because maybe nothing is matching with these conditions. So in such a case, or even otherwise, if you want to have a little bigger list so that you have the possibility of identifying some trading opportunities out of a bigger list, then what you can do is, you can see that in this scanner, I have given 5 different conditions. You'll disable the third one, you'll run the scan again, and I'll do exactly the same thing for the short scan. I'll disable the third one, run the scan again. And now you can see that initially I was getting 4, but now it is giving me a list of how many? Let's check. Again, you see it's giving me a list of 50 stocks from the long scan. And from the short scan, I'm getting a list of about 24. So we have around 74 symbols to look into. Now, 74 is not a very big number. If you're analyzing 74 symbols, it should not take you more than, I'll say, maybe half an hour, 45 minutes, but definitely less than an hour, right? You should be easily done. And it's not that out of 2000 plus companies, you're still getting a list of 500, 600. It's a very small list which can easily be done. But if you still feel that this is a big number and you further want to filter it out, you can use different filters. And those different filters can be, like here I can say, I don't want from the cash segment. I only want from the ones which are getting traded in futures, or even I can say only from the Nifty 50. So in this example, let's say I select futures, and I'll do exactly the same thing for the short scan, that I don't want from the cash segment. Only the symbols which are getting traded in futures. Will run the scan again. And now you can see I have around 12 plus 10, which is 22 symbols to look into. So you can see from 74, now I'm down to only 22. Now, if I change this to Nifty, it will be a further smaller list. So you can make this list bigger. You can make this list smaller by using different filters. Plus, this is not the only scanner available to you. If you go to the screener section on this website, you will see you have over 150,000 scanners available to you. Some are based on fundamental analysis, top left. You have candlestick patterns. If I further go down, you can see you have based on range breakouts. You have your bullish scans. You have your bearish scans. Then you have your intraday bearish, intraday bullish, crossover. So n number of scanners, they'll give you different results. But always remember, whatever results you're getting, you can never blindly buy, sell. Again, the job of the scanner is not to tell you what you need to buy or sell. It's just to help you get a smaller list out of a bigger list. So coming back, in this example, you saw that after running the scanner, we got a list of about 74 symbols. Now, once you start analyzing these symbols, a few challenges which you will realize. Challenge number 1, you will realize that majority of these symbols in this list do not have a quality demand area or a quality supply area on the lower time frame. which means you will be wasting a lot of time analyzing such symbols where you don't have any opportunity available. And the reason for that is because all these scanner screeners are either based on conventional technical analysis or fundamental analysis. They have nothing to do with demand supply zones. And second thing is that even if they do have some demand supply areas, those demand supply areas might be far from the current market price. Again, the reason is because the scanners are not based on demand supply zones. So just because something is getting shortlisted does not guarantee that the current market price will be closer to those demand supply areas, which means you'll have to wait for a longer period of time before the prices are back to your zone. And during this waiting period, what might also happen is the price action that develops might disqualify that trade setup by the time it is back to your zone. So these are some of the challenges we face, and to overcome these challenges, I have also created some custom built tools which we call as the alert service and the screener. Now both of them are based on demand supply zones, so that is how challenge number one is taken care. Alerts, they get generated as soon as a zone is formed, so your current candle will always be close to the zone, because as soon as the zone is formed, the alert is generated, which takes care of your challenge number two when it comes to alerts. And screener, you can define how close the current candle should be to a zone before it gets shortlisted for us, so that also takes care of your challenge number two. Now alerts, we do have a walkthrough video available. The link is available in the description. Plus, we also have the demo channel for alerts. If you want to try out alerts, you can join the demo channel. We have the demo channel for MCX. We have the demo channel for NSE and Forex as well. But again, I'll add, these are not call giving or tip giving services. These are scanners which are purely based on demand supply zones. And we also have a walkthrough video for screener. Again, link is available in the description. Plus, I would also like to add that, again, whatever scanner screeners I'm talking about, these are not mandatory tools. These are optional tools. These are few tools which are available to you. If you wish to use them, yes, you can. If you don't wish to use them, I showed you over 150,000 scanners which are available to you for free. And plus, that is just one single website. If you do a Google search, you'll be able to find a number of websites, a number of scanners. Process can also be as simple as, I don't want to use any of these scanner screeners because I want a small list. I will only be analyzing the 50 stocks which are on the Nifty 50 index, or maybe I have my own favorite list of stocks which I want to analyze every other day. So choice is yours how you get that small list, right? But it's not mandatory that you need to have these tools to get a small list. It's your choice how you want to get it. But definitely, if your tools are more aligned with the demand supply process, the probability of finding a quality opportunity definitely increases, right? That's the only positive side to it. Anyways, so let's assume whatever process you used, you applied, you got a list of symbols, and in that list, the very first one was ABC. So now what we need to do is we need to analyze ABC and check, does it have any zones which match with my trade plan? If the answer is yes, we have an opportunity. If the answer is no, then we move on to the next one, then the next one, then the next one. And that is how we identify our trading opportunities. So what we need to do next is we need to go to the lower time frame. So the question here is, what is my lower time frame? And we got the answer from our step number one, that as a weekly income trader, our four different time frames were weekly, daily, 60 and 15, out of which 60 minutes was my lower time frame. So here lower time frame would imply 60 minutes. And what I need to do on 60 minutes, I need to identify zone, and zone can be any of these four structures: a drop based rally, rally based rally, rally based drop, or a drop based drop. So let's go to the lower time frame. Again, like I said, at the time of analysis, I'm not disclosing the name of the symbol, and that is on purpose because, like I said, it's not a session to share calls or tips with you. It is a session for you to understand how to apply the process, how to do the complete analysis all by yourself, so that you don't have to lean on me to give you trading ideas. You can identify your trading ideas all by yourselves eventually. But yes, definitely once these trades they get triggered, I do share the name of the symbols, and we also review them, like we just reviewed the ABFRL and the Salzer electric, right? So yes, after the trigger, I'll definitely share the name of these symbols with you. Now, again, I'll add before we move ahead that if you people are, liking these sessions, make sure you hit the thumbs up button. And if you have any questions, queries, comments, you can definitely put it in the comment section. Most important, if you're not subscribed to my channel, make sure you subscribe to it so that whenever I do these live sessions, you get notified for it. And yes, if you are on some trading groups, or if your friends or family members are into trading, or they wish to learn trading, you can definitely share the link to the channel and to the course content so that people can take advantage of it. All right, now today's analysis you will see will be I won't say complex, but generally the trading ideas I've been sharing with you initially were very simplified, very simple examples. But like I said, when we learn something, we take textbook examples, which are very, very easy. But when we are doing the analysis, so I'm not saying it's complicated. It's just that, if you're just starting with demand and supply methodology, it might be the lack of experience, right? Because for me, this is also very, very simple. But today's example is a little much more than a very simple process where we identified a zone and then we are rating that zone. Today, you will see we will have a zone which will get disqualified, and then we'll have a zone from which we'll have to shift to another zone. So it might feel a little overwhelming, but the only reason why it might feel a little overwhelming is because you just started learning the process. But the very first session, I talked exactly about the same thing, that we will start with very simple examples. But as we progress, we will start building in some complexities into it. And that is why I would also add, it is very, very important that you don't miss upon any of the sessions. If you're not available to join live, at least watch the recordings later, because from every session you will get something to learn. And at times the next session we are doing might have something which might be connected to the session that we did before. So if you miss any of these sessions, you might miss on some important aspects. So always ensure that if you're not able to join live, you at least later watch the recording so that you don't miss upon anything. All right, so whenever we talk about demand supply methodology, I always say demand supply is a price action based methodology. And what do we mean by price action? Price action means the action done by the price. And what action can price do? Price can only do two things. It can either move up or move down. It cannot do anything else. But when price is moving in a narrow range, we call it as the period of pause, or we can also call it as our basing. Now, initially, when we start learning demand supply methodology, our eyes are not trained to identify these structures. So that is the time we start with a very mechanical process, which we call as boring exciting candles. The last few sessions, I have showed you examples that yes, with boring exciting also, we would have identified exactly the same zone. But in these sessions, I will be leaning purely against the demand and supply zone indicator, because it makes the process very mechanical, very rule-based, and also easier to apply. But we do have the boring candle indicator, which is an absolutely free indicator. You can use the boring candle indicator for free forever. Similarly, we have the explosive move indicator, which is again an absolutely free indicator. You can use it for free forever. Though the demand supply zone indicator is subscription based, but again, it's not mandatory that you need to use these indicators. If your eyes are trained eventually, you can even do it without the use any of these indicators. But I will be leaning against purely these indicators to make the process faster, mechanical, and easier. So you can see, as soon as we apply the demand and supply zone indicator, it is automatically identifying the demand areas and the supply areas for us. All we need to do is check whether these areas are qualified based on our trade plan or not. If they are qualified, they can be our opportunities. If they are not qualified, we'll simply skip them. So if I start from the current market price, here you can see we have this drop-based rally structure. So let's draw this demand zone, which is this drop-based rally. Now, I have been saying this in almost every other session that once we have identified the zone, this is where demand supply traders, they make the biggest mistake. So our step number 3 was identify zone on the lower time frame, which the indicator did automatically for us. So do we have a zone available? The answer is yes. But just because we have a zone available does not mean we can blindly buy at any demand area or blindly sell at any supply area. And this is the biggest mistake demand supply traders, they do initially. They find any demand zone, they start buying on it. They find any supply zone, they start selling on it, which is not the correct approach. Once the demand zone or the supply zone has been identified, the next thing is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the booster scoring. Only if it qualifies on both these conditions, then we might use it as our trading opportunity. If they don't qualify, then anyhow, we're not using it. So when it comes to these conditions, right, we need to check whether the zone is case of level on top of level or not, whether it is because of a gap or not, pivot non-authenticity, and unstable equilibrium. Now, if I go back to the chart, you can see here we have a drop-based rally structure, and drop-based rally is what we call as a pivot or a non-authentic zone. Now, if you talk about the rules of pivot and non-authentic zone, let's bring up the rule book and let's go to PIVOT, right? So the rule says that if you're applying the aggressive approach, now I've given you two approaches. Aggressive is why? Because here we are looking at just one condition. And then I've also given a conservative approach where we are looking at two conditions to have a little extra probability. So the aggressive rule says that if you are looking at a pivot or an authentic zone, to qualify it, you need to ensure that the move from this zone was able to violate at least one opposing zone on the intermediate time frame. So since we know these structures, they have a little lesser probability, we want to add extra probability. And the way we are adding extra probability is that when this demand was formed, if this move to the upside has violated a supply zone of a bigger time frame, which is intermediate, that basically tells me this has a little bit strength because a smaller time frame zone was able to defeat a bigger time frame zone. So if I go to my daily time frame, here you can see, which is my intermediate, we do have a daily supply zone, which is this drop base drop, but it has not yet been breached. So since the lower time frame zone has not yet violated the intermediate time frame zone, this is not qualified for me based on the conservative approach. But let's assume on Monday or Tuesday prices they move up, then this will get qualified and we might have to revise our analysis and come back to this zone. But currently we cannot use it because the opposing zone has not yet been violated. So that was the aggressive approach based on which this is not qualified for us. If I go with the conservative approach, here we look at two conditions. It is two conditions, one and two. It does not say one or, right? Can you see it is and? So one of the condition is that we need to have an impulsive move on the intermediate time frame, plus we need to have an authentic zone on the refining time frame. So if you look at your intermediate time frame, only once it goes above this, we can call this move as a impulsive move. So since the impulsive move is missing, anyhow, it will not qualify even based on the conservative approach. So even though we have a zone, irrespective whether we apply the aggressive approach or the conservative approach, as if today this is disqualified, we cannot use this zone. And that is why it is important for us to understand all these aspects, and only if a zone qualifies based on all these aspects, we use it. So can you see someone who would have blindly taken the zone is incorrect, right? But that does not mean it cannot work, right? Prices can come to the zone, it can give you a really nice move. But when we are planning our trades, we need to ensure we are picking the best of the best zones based on our understanding, based on our experience, based on our rules, right? So this one gets disqualified. Now, where is the next demand area? The next demand area is right here. So let's mark this one. And then let's also check all these conditions. So again, the very first one is level on top of level. And how do we verify that? Very simple. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level, but if we don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Now, as a weekly income trader, our intermediate time frame zone is daily, and here you can see on the daily we do have a rally-based rally structure available to us. So let's mark this rally-based rally, and what I'll do is I'll change the color so that we can differentiate between the two. So now the one in pink is my intermediate time frame zone, the one in green is my lower time frame zone. So if I again go back to my lower time frame, is my lower time frame zone inside my intermediate time frame zone? Answer is yes, which makes it as a coinciding level. So we do have a coinciding level. So now we need to check that do we have a case of level on top of level? And for level on top of level, it is not mandatory that the other zone might be a quality zone. So that is why I'll change the indicator settings that I just don't want quality zones. I want all demand supply zone structures, right? So once I change these settings, now you will see that it is identifying all the structures, even if they are not quality areas. And now we definitely have an intermediate time frame zone, which on the lower time frame is dividing into multiple zones. So since we have an intermediate time frame zone which is dividing into multiple zones, we call it as a case of level on top of level. And what we should be doing in such a case? In such a case, we should be using the lower level, which is this one. But I have talked about this in the last, I'll say 2-3 sessions, that whenever I see such a scenario, to have my stop loss at a little better location, I use the distal line of the intermediate. I don't use the distal line of the lower time frame. Now, is it mandatory? Again, it is not mandatory. It's your personal preference. It's your personality style. I like to be on the conservative side. So what I've done is, in a way, if you think about it, this was my intermediate time frame zone. Now I'm trying to take a deeper entry, but my stop loss is still at the best location. If I don't put my stop loss at a better location, at times what might happen is prices might go a little deeper, stop me out, and then start going in my favor. So I always like to make these modification because I'm okay with missing the trade, but at least my stop loss should always be at the best location. That is what I prefer. But again, just because I'm doing it does not mean everyone has to do it, because narrower zones have their own advantages, wider zones have their own advantages. Similarly, narrower zones have their own disadvantages, wider zones, they have their own disadvantages. At the end of the day, you will have to choose based on your experience, based on your personality style, what you're more inclined towards. And this is what I'm more inclined towards. So you can see that uh, once we started applying the rules, we have actually picked something which was not even on the chart while we started with our analysis, right? So you can see this one was avoided, this one was avoided, and now we have something else which, if we are talking about quality levels, is not even getting shown on the chart. That is why very important, you need to be mechanical and rule based. So yes, we have identified the zone, and now since we have identified the zone, we can move ahead. Let's see. So now, yes, it was a case of level on top of level. We made the shift which was required. The zone is not because of a gap, therefore gap rules will not apply. Now, if you talk about pivot and no authenticity, now you might say this is also a drop based rally structure because the leg in is a red color candle. So if I just break this up, right, you might call it as a drop based rally structure, which you will say, okay, there is a structure of pivot. Let's again apply the rules of pivot nor authentic. In such a scenario, this is where your rule book will again help you. You can see in the rule book, I have given you a rule that in case of level on top of level, you can see in case of level on top of level, we might have a pivot or a non-authentic zone, but there is no need to apply the rules of pivot and non-authentic because the extra probability we are looking for is by default there as a case of level on top of level. So the rules of pivot and non-authenticity can be skipped here. Plus, even if you think about it, this candle is basically a bullish candle. So you can see the indicator is actually marking it as a rally-based rally for us. It is not marking it as a drop-based rally for us. So if I go to the indicator settings and I tell the indicator that display the name of the patterns, you will see it will display it as a rally-based rally structure. It will not display it as a, can you see it's displaying it as a rally-based rally structure. Now, if you want that the indicator should be identifying the patterns based on the color of the candle, so here you have that option. Can you see my current leg-in method is the candle type. Since it is a bullish candle, it is taking it as a rally-based rally. But if I change it to candle color, now it will call it as a drop-based rally. You will see it will just get revised in few seconds. Can you see now it is calling it as a drop-based rally. So again, because demand supply methodology is based on price action, I prefer to do it based on the candle type, not based on the color of the candle. But yes, these are some personal preferences. If you wish to modify it, you can make those modifications. You do have that option available in the indicator. All right, so yes, we have identified the zone, irrespective whether you are considering it as a drop-based rally or a rally-based rally. In both the cases, pivot nor authentic rules will not be applicable. Next, unstable equilibrium. It's not a case of unstable equilibrium. So after looking at all the applicable rules, is the zone qualified? The answer is yes. And now that we have a qualified zone, the next thing we'll do is the booster scoring. So let's bring up the boosters. Give me a second. So the first one is freshness. The zone is definitely fresh, gets a score of 3. Strength, you can see after leaving the zone, we immediately went flat. So we do not have a follow-through pattern or an explosive move, gets a score of 0. Time at the zone, we have... oops, my bad. So time at the zone, we have only 2 candles in the basing, gets a score of 2. Reward to risk ratio will take as an assumption. Now in the previous session also, when we took case of level on top of level, I showed you the rules for the structures of pivot and for the not the structure, the characteristics of cases of level on top of level, where we talked about in case of level on top of level, we can look into the intermediate time frame to check whether we can upgrade the scoring or not. So here also you can see we don't have an explosive move, we don't have a follow through pattern, so I can't upgrade this one. Rest I don't need to check because something which already has the highest score will remain intact. Only the ones which do not have the highest score, we can double check on the intermediate time frame in case of level on top of level, but in this case this is not getting upgraded, so it will still remain exactly the same. All right, moving ahead. If you talk about your location, if I go to the weekly time frame, let's see what is the location. You can see we are planning our trade at middle of the curve. So location is taken from the entry price, not from the stop loss. So the entry price is at this gray shaded area, which is middle of the curve, gets a score of 0. Trend, if I go to the daily time frame, you can see we are in sideways because we have one demand violation, one supply violation. So sideways again will get a score of 0. Now this will make the trade fall under the category of an aggressive trade because ideally if we are in middle of the curve, we should only be planning trades in an uptrend. Now, yes, if you are looking at price action, based on price action, you might say we have higher lows, higher highs. So that is why it is still acceptable. But otherwise, I'll put it under the category of a little aggressive trade. But yes, it is still okay because what the price action is showing us. Now, move from the zone, we need minimum 3:1, and do we have a move which is more than 3:1? The answer is yes, gets a score of 2. It is a case of level on top of level. It is also a coinciding level. So the fact is, by default, it has already converted into a type 1 trade. So even if you want to skip analyzing trap, it can be skipped because whether it is 0 or 1 doesn't make any difference. But it will get a score of 1, and the reason for that is if I take a horizontal line, wherever the proximal is, and I start pushing it up, you can see that we do have this area which in the past has worked like resistance, again worked like support, worked like resistance, worked like almost resistance, resistance, resistance. Then here it is working like support, again working like support. So we have almost a textbook example of support resistance. Now people who believe in support resistance, at support they would buy, and their stop losses will be sell orders which will be placed below this area. Similarly, if we get a breakout, people who believe in breakout will also start selling. So we know by the time we come into the zone, we'll have a lot of selling coming into. And these people who are now selling, making two key novice mistakes. Selling after a decline in price means selling cheap, and selling in an area where the chart has proven to us back in history demand exceeded supply, which is the only reason for prices to move up. So yes, that possibility is there that it might work like a trap, for which I gave it a score of 1. So if you look at the overall scoring, we have a score of 8 for quality, which makes it as a medium quality zone. But since it is high probability, medium quality, high probability can be done as a type 1 trade. Next, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation. Now, whenever the prices are back, we'll have to re-verify because markets are not static. Markets are dynamic. Conditions are changing almost every other second. So you'll have to re-verify whether it qualifies based on our trade plan or not. If it qualifies, we'll place our order based on the entry type, in this case type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade, which we saw in the case of ABFRL. And after that, if we get the opportunity to trail onto it, we can start using our trailing stop loss, which we also saw in the case of ABFRL, which would have given you an exit at about 1.5:1. So this is how we plan trades, very mechanically, very rule-based, and that takes care of our analysis for today. Now, before we close the session, I'll definitely go through the chat box and take some random questions, queries. I'll answer them. At times, I might not be able to take all the questions, queries, but yes, I'll try to answer as many as possible. So let's see what do we have in the chat box. In my small experience of 10 years and one word I want to say, irrespective of what you learn and master, if you are desperate to make money from market, we will definitely not make money following strict RPT. So I'm not able to understand what you mean by strict RPT. So if you can just elaborate on it, I might be able to, be in a better position to answer that. Let's see. My suggestion, any platform which provides facility for type 2 type 3 entry. Okay, so can you suggest any platform? See, the problem is when it comes to type 2 type 3 entries, it cannot be automated, and that is something we talked about in the lessons, that what is the downside of type 2 type 3 entries. They cannot be automated. Why? Because you'll have to wait for a bearish or a very bearish candle in supply, or a bullish or a very bullish candle in demand. So that cannot be automated. But yes, once you have seen that bullish candle, after that, if you want to place a type 3 entry, it can be automated. You can place a type 3 entry. For type 2, anyhow, you would immediately buy at the market price. But it is not possible that the platform automatically identifies what kind of a candle has formed and then places your order. So I don't know of any such platform as of today. Right, so everyone, I guess you need to keep a dedicated balance when utilizing a dynamic trailing stop loss, so because you want to make money, but you might run the risk of being stopped out. Okay, so what you're saying is, yep. So you're saying is we need to keep a delicate balance between using a trailing stop loss. See, again, I completely understand that, and I would also say when it comes to trailing stop loss, it's not just anytime you see a demand area or a supply area, you revise it. You'll also have to understand where you are placed on the curve, because the better is your location, the more conservative you can be with your trailing stop loss, right? And the worse your location, the more aggressive you should be with your stop loss. So there are a lot of factors which you'll have to look into, and based on that, yes, you can definitely make your modifications. Or can you please provide video link on trend identification? I find it very difficult. See, again, Vijay, we have the complete playlist available to you. And in the playlist, all these lessons are, in a very systematic way. So I can't recall which lesson would be the lesson on the trends, but in the thumbnail, I have mentioned all the topics. So if you just go through the thumbnail in the playlist, you will get to know in which lesson we covered the trends, and that is the one you can watch, right? As if now I just had the on my fingertips, I would not be able to recall on which particular lesson we were covering trends, but the thumbnail will definitely tell you. Request you to do a practical approach analysis example of an hourly hourly intraday trade. See now, the challenge here is that I do not do separate homework for these sessions. Whatever I'm identifying for myself, out of that, I share some trading ideas with you. So if now, fact is, when I'm planning my trades, 100% of my trades are MIT trades, right? That is what I'm doing. But those MIT trades, I convert it into WITs and I share it with you. Similarly, if I find any opportunities moving ahead which can also be shared as DIT, I'll definitely do that. And if I even find something which can be shared as an HIT, I'll do that. But again, it's been just 3-4 sessions as of now. So eventually, as we have more and more sessions, every kind of example will be taken care. Initially, I guess we looked into some MITs. Now we are looking into WITs. But yes, if I find something which is a good DIT or an HIT trade, I'll definitely share with you. But if you go through a comparison between an MIT and a WIT, what you'll realize is nothing is changing. The only thing that is changing is the time frames, right? So the analysis today, which I did, it was daily, weekly, 60 and 15, right? These time frames could have been 60, 15, 5 and 1, but nothing will change. Everything will remain exactly the same. So that is why it doesn't make a lot of difference. It's just the time frame changing. But yes, eventually, if I find some HIT examples, DIT examples, I'll also share it. But like I said, for these sessions, I'm not doing the homework separately. Whatever homework I do for myself, out of that, I share some trading ideas with you. All right. Let's see what do we have next. So Rakesh is Hindi language, sir. So Rakesh, we already have a, a separate channel for Hindi on which we have already done the analysis for today. So in case you're not aware of it, the name of the channel is Trading Munch. The link is available in the description, so you can join the Hindi channel. And on the Hindi channel, whenever we are doing our analysis, we are doing the sessions, we are doing them in pure Hindi, right? So this is the English channel. Here we'll only be doing in English. The Hindi channel is where we'll be doing it in Hindi. So why this demand are considered a pivot? It hasn't tested any previous zone. See, even if it has not tested any previous zone, right? If you think about it, in conventional technical analysis, everyone is looking at these pivot highs, pivot lows for trend identification. They are looking at these pivot high, pivot lows for support resistance levels. So even if it is not a test of a previous zone, it is still something which is extensively used in conventional technical analysis. And what everyone is using, if you're also using exactly the same thing, that does not give us any edge. So that is why, and again, what might happen is you might not see it as a test of a previous zone on this particular time frame, but on a different time frame, it might be a test of a previous zone. That can also happen. But like I said, even if it is not, these pivot highs, pivot lows are used in, I'll say, probably everything which is conventional technical analysis. So that is why also we need to be careful of something which everyone is using, right? So that is how it is going to be. All right. Why didn't you look at all the zones initially, only during checking LOTL, we check the checkbox for all zones. See, the reason for that is when we are planning our trades on the lower time frame, we would always like to use the best of the best zones. That is why we want only to use quality zones. But when we are talking about cases of level on top of level, we have first already identified the best zone, and then we are seeing whether we can further fine tune the trade setup we have identified. So that is the reason, because if you go to the characteristics that I've given in the rule book for cases of level on top of level, that is where we talk about that it is not mandatory that the other zone might be a quality zone. So again, when we are starting, we definitely want to start with the best areas. And yes, if they prove to be case of level on top of level, that is where we can make those modifications. But we don't want to by default start with all zones and start leaning against zones which might not be even quality zones. So that is why by default, because can you see if I bring up all zones, we have n number of areas. So this is the very first filter we are doing. We don't want to use all zones. First, we want to start only with the quality areas. All right. Let's see what do we have. So what does the CTA acronym means on page number 58 on the rulebook? All right, let's see what do we have. So CTA will be conventional technical analysis, right? So if it says CTA, it will be conventional technical analysis. Conventional means anything that is not related to demand supply methodology, anything that is related to the conventionals, which is indicators, then you have your oscillators, then you have your candlestick patterns, chart patterns, right? All those things which are taught in trading books, that is what we call as conventional technical analysis. What steps do we take to verify? So again, the way we are qualifying the trade setup for us, it's exactly the same thing which we need to verify whether it gets qualified for us or not. So I've taken courses from Sher Khan. I like your videos. Is there any way I can talk to you? See, again, we are definitely having this conversation. The only thing is I'm speaking on the mic. You're putting it in the chat box. But yes, if there is something specific, you can definitely send us an email to info@surjitkaga.com. We'll definitely look into it. If there is some questions, queries, it will be answered to you. So do not worry. But yes, so as of now, initially we did have some phone support as well, but it is a lot of traffic which we get, so that is why we have stopped with the phone support. It's only via email now. All right, so Sruji, thank you. Another great session, providing great nuggets of information. So happy to know that these sessions are helping you and you are finding them useful. All right, so let's see what else do we have. Great. It works in Forex. Absolutely. The methodology is universal. You can use it on any asset class, be that stocks, futures, commodities, Forex, cryptos, right? Any style of trading you want to do, be that intraday, be that swing trading, be that long-term investment. So it's a universal strategy. And in fact, if you look into my YouTube channel, you will see for the last X number of years, I have been doing some weekly analysis session where we used to cover Indian markets, international markets, including Forex and cryptos as well. So those sessions are also available. But that is the time we do not used to go very in depth into the analysis. I would just tell you, okay, these are some of the areas. But now we are going more in depth into it and understanding the complete process behind it. All right, let's see what do we have. Great. Is it possible to shift the time to afternoon as earlier? So yes, we do have afternoon, but the afternoon session is the Hindi sessions, right? So we are doing the Hindi sessions in the afternoon. The evening session will be the English session. All right, so can you give some homework that can help us? See, the only homework you can probably do is I don't know, because I'm not disclosing the name of the script. I'm not disclosing anything at the time of analysis. So the only homework I'll say is probably practice as much as you can. Because once you start practicing all by yourself, whatever challenges you're facing while I do the analysis, many of them will be answered by default. So I think that is the only thing you can do based on the way these sessions are planned. All right. How to calculate position size when trading in options. So this is not an options session, so we'll not be getting into it, but uh, eventually maybe sometime we'll do a session where we might touch upon it. Is it possible for you to please show how you plan monthly income trades? So if you start with the very first session, I guess the very first session was an MIT trade, right? So you can look at the very first session, not just the very first. I guess the first two might be MIT trades. So I do keep mixing, and that is why I was saying that do try that you do not miss on any of these sessions, because these might be linked to one another. And if you're not able to join live, at least watch the recordings. So whatever answers you're looking for, whatever things you're looking for, eventually everything will get covered, or they might have already been covered in the previous session. So do ensure that you do not miss on any sessions. So home says speak in Hindi. So again, I have already said this. This is an English channel. We have a separate channel for Hindi. So if you want the sessions in Hindi, you want to join the live sessions in Hindi, you need to subscribe to the other channel and join those sessions, which will be purely in Hindi. So this will be English. Hindi session is on the other channel, which is Trading Munch. All right. Let's see what do we have next. Thanks a lot for today. Looking forward to next week. All right. Thank you so much. So can you help us on mistakes that we have made? See again, because we are not doing the review of your trades, I can't help you with that. Plus, even if you email, it's not possible because, like I was telling you, we get a lot of traffic, and when it comes to identifying mistakes, only I can do that. My team cannot do it. So again, I can't be sitting on the PC the whole day and answering a number of emails. So the only thing is you will have to learn from these practical sessions and maybe try to connect with what mistakes you have been doing and how those can be taken care of while you learn the correct way to do the analysis. All right. Let's see what do we have next. All right. So already answered. Does it work in forex? Will the videos on your channel suffice our knowledge, or is there more? So again, whatever we have on our channel completes covers the complete demand supply methodology. Nothing is missing from there. So it's not that we are keeping something hidden and later we'll tell you, okay, if you want to learn this, now you'll have to pay for it. So do not assume anything is getting hidden for you. Everything is available to you. Whatever we used to teach in our paid courses, you're getting exactly the same content. So nothing is hidden. Don't worry about it. All right. So helpful and informative. Thank you. Why do you trade only MIT trades? Are you not interested in DITs and WITs? See, yes, initially I used to do a lot of DITs and WITs, but now I'm more into a laid back kind of a trading approach. So with MITs, what happens is I don't need to be very actively present, which gives me my free time as well. So that is the reason I've transitioned to strictly MIT trades because I like to have, see again, uh, you know, at times what people do is people make trading their lifestyle. Now what do I mean by that? That from the time the market opens till the market closes, they are in front of the PC. I don't like that. I only want to be in front of the PC when, let's say, prices are coming close to my zone for which I have my alerts placed. So if it is going to be DITs, WITs, there will be too many alerts and I'll definitely have to spend more time in front of the PC. So just to avoid that, and that is also one of the reason I have also stopped taking the paid lessons, because then I was taking sessions 6 days a week. Now I'm only doing it once. The only reason I'm also doing it once is because, it keeps me connected to you people. Plus, when I do it for you, in a way, I'm also reinforcing the rules on me, right? So that is also a hidden reason behind why I don't want it to stop completely, right? So yes, because I like my free time, I don't like to be bounded a lot. So that is why I'm more into MIT trades now. All right, let's see what do we have next. Uh, we have shared our to understand Telegram channel. See again, reality to trade sync. Those are not calls or tips which you're saying how to understand Telegram channel calls. Like I already said, these are not calls or tips. This is a scanner which is helping you shortlist symbols where the zones are getting formed. Once the zones are formed, the way we are doing the analysis, the complete analysis has to be done to understand whether it matches with your trade plan or not. I want to learn more personally from you or your team. Can I connect? See, again, we don't do personal classes. So, yes, even if you try to, even if you connect with us, that is not going to be possible because I don't do personal classes as of today. And again, even if we are doing personal classes, it's exactly the same thing which you're learning here, right? So, why not, when you have the access to everything for free, just enjoy it. So that's how it is. Right, let's see what do we have next. So I want to backtest and demand supply for refining myself. So how shall I do that? So again, I'll suggest backtesting would not help a lot because with demand supply methodology, we are not leaning against one time frames. We are using multiple time frames, which makes backtesting even more challenging. So the process that I've explained how to start trading, follow that process. That will be the right approach. All right, practice locating zones really helps. That is training your eyes to spot in very rewarding and building. Absolutely. All right. Not sure if I asked the question before. Do you offer an alert service for the US markets, or you have to use the scanner instead? See, again, for the US market, we are only providing alerts for some of the Forex symbols. But what happens is with the alerts, you do get access to demand and supply zone indicator with the alert feature where you can place your custom alerts, right? But the number of alerts you can place will depend upon your subscription level with TradingView. So what you can do is you can go through the walkthrough video of the alerts that will help you understand the complete process. But we do not have a channel for US stocks. We only have channel for Forex, where we have about, I guess, about 30 symbols, which is getting, looked into by the alert service, but not for the US stock market. All right. Explain alerts in scanner. Again, like I said, the walkthrough videos, the links are available in the description. You can go through the walkthrough videos. The complete understanding of what alerts are and what scanners are, you will definitely get it from those walkthrough videos, right? It has been already taken care of. All right, so can you give us 1, 2 stocks for analysis as homework? We will analyze and learn. It is a good suggestion. I'll see eventually if we can do something about it. But as of now, I would say it might not be possible because, like I said, I'm only picking things which I'm already doing the homework for me. Out of that, I'm sharing with you, wherein finding one also at times is a little bit challenge. So that's the issue here. All right. So does the demand supply script work on all markets? See, again, the demand supply zone indicator can be applied to any chart that is available on TradingView. But what you need to understand is whatever it is identifying, you cannot blindly buy or sell. It is not giving you buy sell signals. It is just helping you identify where are the zones which needs to be qualified based on your trade plan. So with that at the back of your mind, yes, you can apply to any chart on TradingView. All right. So could you start Q&A session to review our trades? See, again, general Q&As, I'm definitely answering the questions which you people are putting in the chat box. But yes, doing the reviews, let's see if eventually I might start with it, but I'm not very inclined as of now. We eventually will look into it, right? But I'll keep it as a feedback that this is what people are looking for. And eventually, if I feel that, yes, we can get into it, maybe I'll start with it. Could you enable recorded sessions product? See, again, these sessions which I'm doing, the recordings are available to you. So eventually what is going to happen, this archive will also build up. But what happens is if we have to do it from our website, there is a lot of things we have to take care of because a lot of space is required. So again, why to add that cost to you people when you can have the access for free to all these sessions eventually, right? It's just that it will take some time for these archives to build up. Basically, which indicator you use? I only use my demand and supply zone indicator. I don't use any other indicator. All right. So thank you for answering my queries. All right. You're most welcome. And can we do algo trading based on demand supply strategy? See, yes, if you are good enough with the programming, the complete process we are doing can be done. But I definitely believe that indicators or algos can only do mathematical calculations. They do not have experience. And that is where they will lack. You can see even as of now, the identification of the zones, the identification of the curve, the identification of the trend, everything is getting done. So if I want to put everything together into an algo, it can easily be done. But still, I'll say that that human experience will be lacking, and that is why I prefer to do it manually versus working on an algorithm to do the same process for me, because it takes me probably just few seconds to look into a symbol and see whether something is available or not. So when it's not taking a very long time, why not to have that experience added to while we are planning our trades? All right, let's see what do we have. Can we use 75 minutes, 125 minutes time frame? Why not? See, again, time frames are in a way irrelevant, right? What you need to understand is where is a quality zone which matches with my trade plan. So that is what you should be more focused on. So how's your experience been trading all these years? Learning. So my experience has definitely been really, really nice, right? And I'm pretty sure those of you who have been learning demand supply methodology and doing it for over a period of time would feel exactly the same, that this is the right way to go about, and you should also be having a wonderful experience with this approach. All right, so thank you so much everyone for joining in. That brings us to the end of today's session. I will be seeing you now on next Sunday most probably. Till then, trade safe, enjoy your Sunday evening, take care, bye bye.